All right, guys, let's jump straight into it. We're here early July. Obviously, the budget come out in early to mid-May. There are a ton of changes, the largest tax reform we've seen in more than a quarter of a decade. Let's start with negative gearing because I'm keen to hear your thoughts as financial planners. I'll pass over to Jayden, but tell me what your thoughts are on the changes to negative gearing that everyone is clearly aware of.
Yeah, well, I mean, it depends on what side of the debate you sit on, whether you're pro-property or not. But, negative gearing changes. We're not allowed to claim a tax deduction if our property is negatively geared moving forward. What does that achieve? It means people that invest in property are going to have less disposable after-tax income to reinvest back into the property market, basically. I think the government's been pretty good. They want to slow down house growth. They want to limit the amount of people that can play or participate in this game. I think on the whole, these changes for a society are pretty good. I think they're pretty well targeted because I don't believe property is a productive asset class. I don't think it is something that should really be traded as a game for people to build wealth. And, it's a good that I think most people should have access to. There's obviously caveats with that. I'm not a socialist, but I think everyone deserves a right to own their own home. So I think the negative gearing change is a really positive one. I don't think it's by any stretch of the imagination the end of the line for property investing either. It's just going to make it harder for people to accumulate, properties in very quick succession. So on the whole, I think it's a really good thing. People are just going to have to adjust their strategy, adjust their expectations, and also probably step back and realize, well, probably had it pretty good for 25 years.
Yep, that's some great points there. I'll pass it over to Sam to unpack and give his thoughts before I give mine.
Yeah, so I'd say obviously this speculative with property investing over the last 10 to 15 years has really ramped up. Obviously post-COVID, people have been getting 20, 30% returns with very little money going into it other than just equity. And then you look at the negative gearing changes as well, which have been huge. It obviously affects people borrowing capacity going forward. So obviously can't get properties one year after another. But with the negative gearing change, you don't lose the negative gearing. You're just offsetting your gain once you sell that property too. So you're just carrying forward losses, similar to how you would have a property within a trust. So negative gearing hasn't essentially gone. It's just you can't use to offset taxable income. So I think that's a positive change in some aspects. Obviously, it just means people need to be more aware of their cash flow going forward and how they can sort of manage this.
Yeah, to bring it back to a point that Jayden made there, it just means that fewer people that could previously play this game, they can't now because you need more surplus cash flow to invest in property relative to what you did before. Without making this a political podcast, and that's not what we are here to do, obviously the changes will have positive and negative effects for society, giving people the right to own their own home. But for us as financial planners, things are going to change for the newer generation that can't access those highly leveraged strategies that people were doing 6 months ago. The game has changed. So the end results of their wealth accumulation journey may be different as well. But that's always going to happen when we have any sort of reform in any sort of area. Let's move it over to trusts. Now, trusts were one of the most controversial things changed, and they have wound things back, which we'll get into a little bit later. But from a financial planner's perspective, can you just run us through what the changes were with trusts and how you think they are going to maybe positively or negatively affect your clients and just society at large?
Yeah, so family trusts have largely been viewed as, let's call it a tax hack. You can put your hard-earned money in from, let's say there's a family, one spouse is earning $500,000 a year, other spouse is earning nothing. As a PAYG employer, you've got no ability to change that tax outcome. He's going to pay or she's going to pay tax on that $500,000. But by using a trust, what you can do is build assets with your after-tax income in this vehicle and then start to stream it to other family members as you see fit. And that's where discretionary trusts got their name from, because it's the discretion of the trustee to distribute wherever you want. So another example is, maybe you do have, rather than just a high earning spouse that's PAYG, maybe you do have a business in there that's earning $1 million a year. Maybe the person from the family that's running that business is earning $190,000. So they're already at the cusp of the highest marginal tax rate. So what you do is with the $1 million of profit, you send it to lower income beneficiaries to lower the overall tax rate of the family group. What the government's proposed is that there's going to be a minimum 30% tax on distributions from trusts. So it'll be in the form of a non-refundable franking credit. So what that means, if you don't use all the credit, the balance left over of that credit just doesn't come back to you. So an example of that, again, just in case it's not really clear, but if I was to receive maybe a $70,000 franking credit, taxable distribution from a trust that had a franking credit attached, usually that would be at a 30% tax rate. So I get my $70,000 in cash. It comes with a $30,000 tax credit. Very similar to someone that might be on $150,000 income. Their employer might pay $40,000 in tax on their behalf to the tax office, and they get $110,000 in cash throughout the year. Okay, so that franking credit works is very similar in the way that your PAYG tax credit works that your employer pays on your behalf. Now, under the current circumstances, if that's all that person earned, the $70,000 plus the $30,000 tax credit, the ATO says, well, you've earned grossed up about $100,000 in income. At about $100,000, maybe you pay $22,000, $23,000 in tax. So the ATO says, well, you owe us $22,000 in tax, but you've also got this franking credit for tax already paid of $30,000. So take that off the $30,000, you've got $8,000. We're going to give this to you because it's a refundable franking credit. So you get the $8,000 back. And with the proposed changes, the government's basically saying, no, you won't get a franking credit back. It's non-refundable. So if you only had to pay $22,000, too bad, you're basically paying $30,000. So that really limits people's ability to get their tax rate below 30% throughout the family group. There's going to be strategies where you can do it to an extent, but there's other problems because we also spoke about corporate beneficiaries won't be eligible for the franking credit offset either. So a bucket company has been a really common strategy for larger family groups that have the income to warrant that strategy. And, the effective tax rate on bucket companies is going to be over 50% if this gets through. So
Absolutely.
Huge changes.
Yeah, massive changes. And with changes, there always needs to be a rollout period. Mm-hmm. So one thing we're aware of is that a lot of these laws aren't going to come into effect for a couple of years. At the moment, with things around trusts, it will be 1 July 2028 based on the proposed budget. But Sam, jumping forward to you, tell us a little bit about how you view these changes and what are you doing for clients at a really high level that may have these structures in place between now and 1 July 2028?
Yeah, good question, Riley. So touching on that, just waiting to see what these changes actually come out at is one of the main things I'm looking at. I'm not going to be making drastic changes to it. We've got the proposals actually gone through, received royal assent, gone through everything. There's no more carve-outs like we've seen with Testamentary trusts that got carved out. So sort of sitting and waiting to see what's going to happen. There's going to be talks of rollover relief. But another thing I want to touch on with the trusts and everything, looking at sort of the minimum tax rates around 30%, they're sort of trying to bring it in line to what, if you were to earn an income, you're looking around that 32 Medicare levy rate. So I think that's really the aim of the government, is trying to make sure that investment income's taxed the same as if you're earning income. So that's one of the big things I've taken away from those changes moving forward. But yeah, sitting back and really looking at, well, what is the purpose of the trust? What are we trying to achieve here? Is there another structure we can look at, say, as an investment company going forward? Obviously, the benefits of the investment company, you can keep retained profits in and you sort of tax at that 30% rate. But yeah, just sitting back and waiting until we've got that in paper, we're all sent, we know what's going to happen first, and then making those decisions, not just rushing in, trying to make all these changes before we actually know what's going to happen.
Yeah, that's a great point there. And with these changes, it was like a switch at 7 to 8 p.m. on, I believe it was the 14th of May. 12th, there you go. The 12th of May at roughly 7:30, 8:30, we knew all of these things were coming through, and it was like somebody switched a light switch into panic mode for a lot of these people. But
Stop the nation.
It stopped the nation. It was humongous, and I'm sure accountants are feeling it just as much, if not more than us, given they'll actually do the restructuring advice. But for most people, it is really a sit and wait game. You know that the rules are going to change, but you do not need to make radical changes at this point in time.
I think just on that point, though, there is a few people, and we've spoken about this at length the last 2 months, is there's people that are implementing strategies, people that have finally taken the courage of sought advice, they're ready to go. And, before this had come out, we'd recommended trusts to these clients. So there are people that are in this in between. They're ready to implement. They're ready to go. It's like, well, what do we do? These are the proposed changes. One, they're not law yet. Two, if they do become law, there's proposed, 3 years of restructure relief that you'll get. But then it's also like, well, if things don't change or they're, scaled back much more
Generously.
generously.
Yeah.
In 2 years, 1 July 28, is a trust still going to be worth it? Or am I just going to set up this structure just to wind it up in 2 years and move to a company anyway? Because right now, for most people, a trust has a really good role to play. But if the law changes as proposed, probably won't. Okay, but it hasn't changed. It hasn't received royal assent. We don't know what's going to happen. It could go through and then another government could come in and repeal it straight away, like some have said.
And you've done all this restructuring, pay the accountants fees, got the advisors involved, and now you've got to do it all again. You're just racking up fees.
That's right. So there's no real winner from it at the moment, just this state of flux we're in, not knowing what the outcome's going to be. But I also think you just got to make a decision. You just got to move on with it. You got to invest. And if that means, well, we'll just invest in our personal name until we know more, or maybe we invest in a company. And if the investments do really well, if it's not a property, and things change or these changes don't come in, we'll just sell out of the company and put them back into a trust or something like that. But there is a few people that are ready to rock and roll. They don't have these structures set up, but they don't probably want to sit on their hands for another 18 months until things come through either. So yeah, there's a bit going on where people need to make some decisions, and some information coming through soon would be really good. So there's some people where we can't just sort of sit on our hands and do nothing, but there's a lot that already had their strategies in place, and we can't really jump at shadows and make changes that haven't been confirmed yet.
Yeah, the number one thing is you just got to invest at the end of the day still, whether it's property, shares, whatever asset class you choose, you still need to invest regardless of what the changes are.
Yeah, you both make great points, and there are people that have set up these structures and are ready to invest, or they've just started their journey and they're ready to go. And it must be frustrating to have these changes come in, which is besides the point. Now, you've both mentioned bucket companies. Now, we had a great conversation the other day around bucket companies. Obviously, it is being called the death of the bucket company, which I'll let you elaborate on in a moment. But one thing, going back to the rollover relief as well, which you also both touched on there are going to be people here that are in suboptimal structures that are going to benefit potentially from the rollover relief, allowing them to fix poorly designed structures to align with the new set of rules. So can you run us through that a little bit and what you're seeing? Because for everybody listening in at home, you specifically niche with business owner clients. That's who you work with. So you're seeing this on the ground more than anyone.
Yeah, I mean, there's a variety of structures out there, and it's interesting working with business owners and many different accountants. There's no consensus on, even with today's rules, what the optimal structure is for any given person. You can have one accountant swear black and blue that this client should be in a trust, where another accountant will say, for X, Y, Z reasons, you can't retain profits in a trust. It's harder to introduce incoming shareholders, another variety of reasons. That a company structure has always been the best structure anyway. Can't get the capital gains discount in a company on assets. So, if you want to sell your business, you've got to sell your company shares, and not many purchasers want to buy the shares in a company. They want to buy the assets of the company. Yeah. So, I mean, you can cut it both ways, and it's a bit like the property shares debate. You got to run it through a lens of, what's the client trying to achieve? What's going to be the realistic outcome for this client? Balance out what's the costs, all these sort of things. So with the changes coming through, it's probably going to be the same thing. There's never going to be a consensus on what's the optimal structure for any given person. Any subject matter expert might have their own flavour and biases that are going to flow into that. But around your point with what the government's proposed, because of these changes, is there's rollover relief. So people might have gone into structures that accountant recommended based on their expected circumstances was the right thing for them. And, maybe that was at the time they thought, look, he's a Sparky. He doesn't want to run a big show. It's just him. He's doing it as a contractor or a subby or something like that. Best case, he might earn 150, 180. Just run it through a trust. Don't make it overly complicated. All the income's going to come out to you anyway, whatever. Maybe 3 years later, he got so much friggin' work, he just put one of his mates on, and now he's grown to a team of 10, and there's assets, and there's 500K in profit and all this sort of stuff, and he's in a trust. You could restructure it already, but there's some significant tax implications of it, like the CGT costs and a few others, and you can get around that with some of the CGT small business concessions. Okay, but it does involve you having to pay or put money in super, paying your tax bill, or buying active assets, which not everyone's in a position to do. So with the rollover relief that's going to come in, it'll be interesting to see what that actually looks like, because there might be some people that are in company structures already that might roll over to something else for various reasons, because maybe they set up a company for the same reason as that electrician did, and the accountant suggested a company, but just put the shareholder in that one person's name. So, there's no flexibility around dividends or anything like that. So at any point in time, I'm a big believer that you just got to play by the rules at that point in time and use your judgment to provide the best solution for that client, given what we reasonably know about their current circumstances and what they want to achieve. There's going to be a myriad of options. You don't know what's right in hindsight, until hindsight. So you just do your best and kind of go from there. And I think one of the other big parts that lacks a lot is just the education around the options for a lot of these clients too. So for any of our clients that we work with, if things change and we think that, hey, it's worth your while to move structures for reasons X, Y, Z, we'll have that conversation and ultimately the client will decide.
Yeah, you make a great point there, and particularly around the single company structure with one director, one shareholder. The business grows far beyond what they thought it was going to do. And then that person ends up either having a lot of retained earnings in that business, or they're paying themselves a mozza and paying 45 cents in the dollar plus Medicare levies and surcharges, etc. Now, another thing that has changed is the floor on capital gains, or proposed to change. Okay. Now, Sam, you are the in-house retiree specialist. You live and breathe recontribution strategies and people that have held onto properties and all sorts of assets until retirement. How do you view these changes and the minimum taxes for your clients that have held onto all these assets or were planning to until retirement?
A good question. One of the things we always used to look at it as well, when they're in the higher income years, once they get closer to that 60, and they look at, say, offloading the shares, property, and they've got a lower income, obviously you'd create that taxable income, do a contribution to super, and maybe use some catch-ups that have built up. And then you could obviously manage the tax from that perspective and get a lower tax rate. Now with that minimum floor of 30%, that sort of strategy is sort of negated. Obviously on the higher income, and so they do sell, we're still going to get some sort of benefit, but not sort of the same benefits you could have got a couple of years back. But one thing that people haven't sort of spoken about is the indexation of the losses as well from that side. So just say you create a loss in that property, it's a $2,000 loss for that year. Next year it's $5,000 and so forth. And you could be 10 years down the track and you've got a $250K loss you're carrying forward to when you sell the property. But that $250,000 is getting eaten away by inflation and those losses aren't indexed up. So you could have such, say, as a $250,000 loss, but looking forward, it's probably only worth $50,000 in the purchasing power of today. So that's one thing that I think's sort of a bit of a red flag from this budget is inflation's going to eat away at your losses and they're not going to be worth as much when you do sell that property or you do sell down some of your share portfolio. I don't think that's been spoken about enough that, yeah, you're going to still get the negative gearing benefit or loss, but it's not going to be the same effect.
Yeah, you make a great point there. And it's something that I think a lot of people have missed with this. They're saying, well, yeah, we're not going to get our cash back each year through the negative gearing, but I can claim it later. Well, look at the time value of $1 or $2,000 for your example. If someone's holding an asset for 30 years, yeah, that dollar's worth a whole lot less in 30 years.
$250,000 loan back in the early 2000s was massive. Now $250,000 is chicken feed. Like most average loan size now is like $750K.
Yeah, 250 grand you're buying a car and doing your kitchen.
Yeah, if you're lucky.
Now, let's move on because one thing that you guys mentioned before was the carve out for testamentary trusts, and that's been released now for a couple of weeks. It was one thing on budget night that anyone that worked in the legal industry or financial planning, we were sitting here going, how is this going to work? We are talking about really tragic circumstances when these things obviously come into effect. For anybody that's listening that doesn't know what a testamentary trust is, it's a trust created through the operation of your will. Someone has to pass away for it to come into effect. So given that these were going to be swept into these proposals with minimum tax rates and things like that, how are we now seeing the testamentary trust carve out? Do you think it was a carve out that needed to happen? Do you think that it's going to actually help people like clients you currently work with, orphan children? Run us through your thoughts on that.
I think it's, common sense. You know, there's still going to be an element where people who are smart enough can take advantage of this strategy to, effectively get the benefit that they've had through ordinary discretionary trusts at the moment. But I think on the whole, this carve out was really brought in to help vulnerable beneficiaries because that's really what testamentary trust was about. around holding and protecting the assets for vulnerable or minor beneficiaries, rather than putting those assets in their name personally, where, you know, if they wouldn't have the minimum 30% tax rate. So, you know, I think it's just a common sense outcome that's been reached, and a good one on the whole, because testamentary trusts are a pretty common strategy, I would say, for a lot of people we work with to have included in their wills, but we don't have too many in operation. Like, they don't get utilized a whole lot, and I actually don't have the stats, but I'd love to know, like, of the percentage of discretionary trusts that are in existence in Australia, what percentage of those are actually testamentary trusts, because I don't think it'd be very high at all. So, yeah, I think a very common sense carve out.
Exactly.
Proposed, yeah.
Yeah, and we go back to that societal benefit that you talked about before. We're talking about protecting vulnerable parties, people that are leaving children under the age of 18 or even 25, and they just need to protect that capital, because I'll speak for myself here. If I was 18 and received an inheritance, not that there'd be much, to be honest, but if I did receive an inheritance, it would not have been well spent. Okay. Yeah. So it's a common sense approach here. So we've had a great conversation now around the changes. Now, with the new set of rules, like you mentioned, we need to look at alternatives. Now, I'm going to pass over to you, Sam, because one thing that it went through a bit of a popularity fad, you still probably see it on LinkedIn, it may see a resurgence. It's not a structure, but it actually is a financial product. Can you run us through high level investment bonds and how they may actually become more attractive for people that are now facing a minimum tax rate of 30% regardless?
Yeah, so with the investment bonds, basically what they are is just in a vehicle that you're paying a tax on that earnings for the first 10 years or anything it makes. And after 10 years, it becomes tax-free. You can pull money out of it. You can put up to 125% of the previous year's contributions into that bond. Now, that can be favorable if you've got that long-term horizon. But one of the things with the investment bonds you've got to consider is the costs, obviously, what sort of the investment returns are and how diversified that bond is. And if you do need access to it, or you do decide to break it within that 10-year period, that can be pretty detrimental, and there's just less flexibility. So it can be an alternative, but it really just depends on the client's circumstances. And if they need that flexibility, well, it's probably not ideal. But if they can park a certain amount of funds each year into that bond and not touch it regardless of what's happening in the world or in their life, well, it might make sense then. But it really case by case, and I wouldn't say we always go with this strategy. Really just want to weigh it up and weigh up the costs, and what the client's trying to achieve at the end of the day is really how I like to frame it. If it fits into their goals and what they want to achieve, well, it makes sense to do it. But if not, we'll look at other alternatives.
Exactly right. So before the budget proposals, with the way we look at average tax rates from an accounting perspective, not that we are accountants, a lot of the time when you look at an investment bond paid with tax paid at the corporate rate on earnings, it to me didn't always make a lot of sense. I could get a better tax rate elsewhere and retain the flexibility to obviously liquidate the product pre-10 years if that's what I needed to do. Now that we are facing that 30% floor for some people, potentially in the top tax bracket, that could become a solution, right? Investing in a well-diversified portfolio within that, particularly if they don't need the capital for 10 years. But one thing, in my opinion, that hasn't been talked about at all that it just reminded me of is if there wasn't a carve-out for testamentary trusts, I would have loved to have seen the popularity of some of these bond structures and products, because I think they would have become really hot if there were no testamentary trust. People could put wealth for children into these bonds. They never had any intention of touching it. If they pass away, there was still a listed beneficiary on there. And a lot of the time, even if someone was to pass away and that sum of capital was to be inherited, if it was because of death, it was tax-free, even if you hadn't hit that 10-year threshold. So wait and see, or watch and see in this space.
Well, really good. I think you just touched on it. Bonds, very good estate planning tool. Like, that's one of their biggest promoted benefits, is they've got some really good functionality that can help with estate planning, particularly for people where that's high on the priority list around, assets transferring to the right beneficiary at the right time. So investment bonds can play a wonderful role for that. But I was interested because we mentioned, assessing the client's circumstances and, doing it for the right client. Who do we think are the right clients for investment bonds?
Usually you'd want to look at, depending on their life circumstances, higher income earners are usually the most favorable, just with the surplus cash flow, and they obviously don't need to touch it. But some people, if they've got a healthy emergency buffer and their cash flow is fine, they're running fine, there's surplus each month, and they can put up to 125%, that's where you're really going to get that compounding effect over the long term. And say you're in your 40s or even early 50s and you want to start sort of planning that retirement and looking at, say, giving to kids right now, that is a good option to consider. But yeah, like I said, you really need a cash flow, and cash flow is king there. We need to manage the surplus and obviously not touch the funds. So you need to sort of consider in the same lens as superannuation. If you're in your 40s, you can't touch this for 10 years is the mindset I would have at a minimum, and just understanding like, if you put this money away, it's parked and it's not accessible.
Yep.
Yeah. You make some great points there. There are obviously other types of bonds, education bonds and things of that sort, but that's outside the purview of today. The last thing I just want to touch upon, and it almost rehashes something that you just went through there, Jayden. Now, I said you are the in-house business owner specialist at Cruise. That's where you work. Talk to me about, assuming if these proposals get through on 1 July 2028, trusts are now essentially null and void. People are starting to roll into new structures. The trust bucket company combination is dead. What are you going to see, or what do you think you'll see with business owners that previously had a trust that owned the shares in their trading entity? What sort of structures or entities do you see as replacing that trust?
Yeah, well, coming back to the main function of a trust, it was the two main functions were one, asset protection. So protecting your assets from creditors and predators. And then another one was the discretion around managing your tax outcomes. So those are the two main benefits of a trust. With a 30% proposed minimum tax from any distributions from trusts, what people are going to have to do is, again, assess their circumstances and understand, well, from what I can reasonably expect over the lifetime of us owning the business, whatever, is it likely that any of the beneficiaries are going to be under a 30% tax rate anyway? So if they're not, well, maybe a trust is still fine for someone like that. The other thing they've got to understand is, how much value do I place on asset protection? Because without a trust, it's pretty hard to protect your assets. Or it's not hard, it's just harder. It's one less brick wall, I think, in between you and the predators and creditors. So I think if the changes do come through, one thing that's been really valuable for a lot of families is that, you know, they've got a trading company. The shares in that trading company are owned by the trust. Typically, in most trading entities, you don't want to retain too much profit in the business, because using your trading entity, you've got employees, you've got, you know, all the risks that come along with running a business. So having retained profits or assets in that company usually for most people isn't ideal. So what they'd do is they'd pay the retained profits out through the trust, but because in a trust, all the income needs to be distributed every year. And if you don't, you're paying the highest marginal tax rate. That's effectively where bucket companies come in. You could pay the money out to a trust, distribute income to people within the family group, cap their income maybe at, you know, $135,000 or $190,000. And if there's any excess profits, well, you just park it in this bucket company here and just cap your tax rate there at 30%. But with some of these proposed changes, well, that's not ideal, because now I'm paying, or I either don't distribute out all the income from my trading entity through the trust. That means I'm going to build up retained profits in my company, or I do, and I push everyone into a tax rate over and above 47% perhaps. So I think what's going to happen is just really people are going to interpose a holding company in between their trading company. So there's going to be a first step. You have your trading entity. It'll pay dividends out to a holding company. It owns the shares in the trading entity. And then from there, the client, based on their circumstances, will make a decision, like with this holding company, should a trust own the shares, or does mum and dad own the shares, or something else? I think that's largely what we're going to see. And the reason for that is people can get their retained profits out of the company into a holding company, keep the tax rate at 25 or 30%, and then from there make decisions on how to get the money out of the holding company, but at least it won't be in an entity that's carrying risk.
Exactly right. And it also won't be in an entity where this money's piling up and people who are unadvised start to go, oh, what should I do with this money? I'm going to invest it. And then they're investing in their trading entity, which has massive problems for some of the rollovers and just small business CGT advice that you give. Now, you made a great point there around the ceiling of bucket companies versus the floors of minimum tax rates that have been proposed on gains. Now, one thing that I think is really important, that when we look now at a bucket company, no CGT discount. That's the main floor. But in 2 years' time, if nobody's getting the CGT discount, that can make bucket companies a bit more attractive. Obviously, the way indexation is applied to certain entities, that will be different as well. But relative attractiveness compared to what they were pre-budget night, probably gone up a little bit for some people relative to previous. But like you said, it's a case-by-case basis.
There'll be some highly paid admin wages going forward from 2027, 1st July, I think.
Perhaps. I mean, personally, I've always loved investing in companies because although, it's a 30% tax rate, I've never looked at that as tax paid in a bucket company. You get a franking credit. So I just look at it, it's tax paid for now.
And you can manage the tax as well going forward.
Yeah, you can absolutely manage it. We've got plenty of clients where they're probably never going to have the capacity or desire to drain a bucket company either because they're just earning so much money. It's like, well, when are they ever going to start getting money out and getting some of these franking credits back? They're never going to be under a 30% tax rate. We don't know what the future holds, so something may happen. Okay, so for them, well, your tax rate's probably 30%. At least we're capping it there. Okay, and if you need any more money out of a bucket company or something like that, you're going to pay top-up tax. And some people are fine with that, no issues. But I think that's been one of the main benefits that I've really loved around, bucket companies at the moment, allowing people to get more after-tax funds into an entity that they can also invest tax effectively and have better control over their tax outcomes. Because once you pay tax personally, that tax is done. It's paid. You don't get it back. That's it.
It's gone,
It's
and
gone.
they haven't spent it on something good.
No. Whereas in a bucket company, you're retaining credits. So at some point in time, you might be able to get some of that tax back. And so again, even if it's at a minimum 30% tax rate, where for maybe you own a business for 15 years and you've earned 600 grand a year divided by two spouses that could receive the income, that's 300,000. So the highest marginal tax rate starts at 190. So for their lifetime, working lifetimes in that example, $110,000 each. So 220 of the family group is being taxed at 47%. Now that extra 17% on top of the bucket company over a 15-year period is going to be a lot. Okay, once they've paid the tax personally, they're not getting it back. But if you put it in a bucket company with a trust, again, getting it into the bucket company might be the issue with the changes too. But you've still got a chance of smoothing that out over your lifetime and still capping your tax rate or at 30% as opposed to 47, or it'd be about 38, 39, I think.
17% return, not too bad. 47.
I'll take it.
Another great thing that you mentioned there is top-up tax. You actually retain the discretion to say, you have less flexibility, but you retain the discretion to say, hey, I want money out of my bucket company. Yeah, you will have to pay top-up tax and things like that. But if it's going through a trust, it must leave the trust every single financial year. So if you're on the top tax bracket and you've invested in your own names, for argument's sake, you get your dividends, bye-bye 45% plus Medicare levy. Through your trust, same thing, no bucket company, it's coming to you or whoever's in it. In the bucket company, it can just sit there and continue to pile up.
And you can
It's
invest
fantastic.
it.
Yeah. And we probably in this part of the conversation, maybe use bucket company or holding company interchangeably because, it might not be going to a bucket company per se. Under the current rules, it can. If it changes and you implement like a structure that I mentioned before, it sits in the holding company. But yeah, I like that structure because it just gives people flexibility to lower their long-term tax outcomes. Yeah.
I was going to touch on real quick around that CGT discount and being wiped out. And obviously the aim is to help like younger people get in. Like it's basically pulling up the ladder. Like previous generations have got all the benefit from it. And you've cut it here for the next generation coming through. But the whole idea of the budget was to go after the older generations that took advantage of those benefits. So it's kind of like we're cutting you guys off from this because previous generations got all the benefit. So like really it's just hurting younger people, I feel, more if they wanted to get ahead or if they're ambitious, they want to grow, etc. Whereas the ones that are actually going after are all grandfathered. So it doesn't matter to them at the end of the day. They're fine. So I think that's another thing that sort of been disillusioned by the budget, by media, by other factors from the government that people aren't too aware of.
I think the thing that a lot of people need to be aware of as well is under the new indexation rules moving forward, a lot of the time, not every time, but depending on what asset you invest in, whether it is has a higher weighting of its total return of growth relative to income or income relative to growth, under the indexation method, if you are investing purely for growth, the CGT discount was your friend. It will not be moving forward relative to, say, buying some mining stocks in Australia that
Pump income.
Exactly, just pump income and maybe grow its CPI or a little bit above. So it will change the strategy for some people, but for a young 30, 40, 50-year-old, 50-year-old's young apparently, in the height of your career, potentially on the top tax bracket, some of these income producing assets don't make a lot of sense.
I know I'm you, but you were going to look at me when you said 50, Jungle.
Right,
I know
he's
I'm older relative, but I'm not
status.
50.
It's got unk status now.
Keeps calling me a boomer.
So let's move on. One thing that we wanted to do to have a little bit of fun here, obviously I've sort of been hosting. We're going to pass the hosting duties over to Jayden. We're going to do a little bit of a debate here, property versus shares. It is the age-old question that we continue to get asked, and at the moment it's a hot topic. I'm going to take the property side. Sam's going to take the share side. Personally, I wish we were doing this 3 months ago before the reforms, because I had a much better argument then. But Jayden's going to ask some questions. He hasn't got any written down. And what we're going to do is we're just going to go one by one. It's not really about winning. It's a friendly debate with the aim of giving people at home a financial planner's vision of the pros and cons of each asset to help people understand that, hey, we're framing it as one or the other, but it might not always be. But I'll hand over to Jayden to ask some questions, and then we'll go from there.
The age-old debate.
We're asset class agnostic, though. We don't have a preference.
Yeah.
Disclaimer, quick disclaimer in there.
Yeah, I think that's a really good call out too, is, we assess each client on their individual merits, and we're asset class agnostic. And I think, again, anecdotally, if I look back at the last couple of years, I reckon there's been half a dozen to a dozen clients that have come to us, or myself personally, that were adamant about investing in property, and we probably talked them out of it for various reasons. And then the reverse of that is true. People that came to us no interest in investing in property, and we just look at the circumstances and be like, have you thought about this? This is what the benefit could be. And, some said yes, some said no, and we moved on. So I think the point of that is, either of these asset classes can be right for anyone. Just depends on your circumstances, tolerance to risk. And I'm sure a lot of things that you'll cover off both now. But if I go to you, Riley, pro property, why wouldn't I invest in property?
You or somebody at home?
Somebody at home.
Yep. So somebody at home, why wouldn't you invest in property? I'll give you a quintessential example. Most people, when they've reached that point of my home is at 20% LVR or less, and I've got cash that's piled up, I've got more than the offset, I'm thinking about retirement, right? Let's say I'm 45, 50, maybe even older. I want to retire in 10 years, for argument's sake. What's the number one thing you see at the moment if you go out and start to do your research online? It's property, and it's some more property. And don't get me wrong, it's fantastic because pre-budget, if I'm in the top tax bracket, outside of super contributions, I can simultaneously grow my wealth and save tax at the same time and get the benefits of leverage. There wasn't anything else that was going to do that. Super contributions probably come second, but there's caps and it's fully preserved. So that was the number one way. Why wouldn't I invest in property nowadays? Well, for a person like that, let's say they're 52 years of age, by the time I actually get in there, set everything up, get the loans, the power of leverage works best when I actually have a bit of a runway. Now, if the average market cycle, let's say, is 8 to 12 years, assuming we're using buyers, agents and things here to get the best sort of investment grade asset based on my budget, depending on what market I brought in, I may not actually have the time horizon left, depending on your goals, to take full effect of a full market cycle. And I like to say, as a rule of thumb, if I have 10 years or less, to use a cricketing analogy, I have one throw at the stumps. I'm using all my borrowing capacity, potentially all my surplus cash flow. And if I don't get this right, I've probably got super, which I can almost guarantee they don't have enough, right? If they've just been PAYG employee and they spend $100,000 a year, and I have a family home. And if I only have one throw at the stumps, I probably wouldn't do it if I've got 5, 6, 7, 8 years, for argument's sake. And that's just when I find most people are sort of pulling their heads in and doing it.
Yeah. So why wouldn't I invest in property for you as if you didn't have a long enough time horizon?
That's the biggest one. I think if you've got the time horizon, like you said before, opening people's eyes to it. If I have the time horizon, I have the income, and I've got maybe, let's say, the family home, for argument's sake, particularly under the new rules, I've got the family home sorted. If my age has a 3 in front of it, or it's sub 45, or even at 45, and if I'm happy to work 20 more years, to go to the reverse of your question, I think it's pretty hard to go any other way, particularly pre-budget night.
So for that person, why would they invest in shares, Sam?
Well, there's a range of reasons. Like if you want the flexibility, selling a property is a bit of a process, and you can't just sell a bathroom or a kitchen and get a bit of funds to go over to, say, on a holiday to Europe or something like that. So shares are a lot more flexible. Obviously, from a property standpoint, banks love property. It's a lot easier to leverage into property. Whereas you can obviously leverage into shares. It does come with a higher interest rate, and that creates a higher hurdle rate you need to get for your return to make it worthwhile to go and invest in shares. But with shares, you're getting a lot more diversification. Obviously, with property, you're picking a suburb or a street. You might have your family home in that same suburb. So you've got a lot of wealth tied up in that one suburb or one area. Say if it's for me, in Townsville, I probably wouldn't look at buying another property in Townsville if I've got a family home there already. I work there, like there's just too much risk there. Whereas if you look at the shares, you can buy an ETF, say in Australia, with the top 300 companies in there. And I'm diversified across like finance, mining, some tech in there. You've got some supermarkets. Like there's so much more diversification. And then you can look on the international side, it's even bigger. And then you look at the costs, owning shares. Obviously, you've got an investment cost there, but I don't have to worry about managing tenant. I don't have any loan repayments. I don't have to worry about insurance, rates, all this other stuff. Obviously, I don't get as much leverage, but on the flip side, I've got probably a lot less stress as well. So that's obviously the pro with shares. There is a few funds now that have brought out internally geared, which we'll probably cover off later on, which I'm a big fan of. So looking from the share standpoint, that's obviously some benefits there. But just say you have $100,000, you go into shares, get a 10% return, you're looking at 110. Or if you go into use 100K and go into property, you might get a 500K property, get a 5% return, you got 25 grand. So do understand that leverage side, but obviously there's less management with a share portfolio. You're going to get a statement each year, look at it. Yep, sweet, continue on. Whereas property is probably a lot more stressful, a lot more hands-on. It's not as passive as people think it is.
Yeah, and you probably started to touch on some of the benefits of property. So Riley, I'll throw back to you. Why would someone invest in property then?
Appreciate you not giving me the negative question to start the round. Why would someone invest in property? Well, why wouldn't you? I mentioned before, you could, under the current rules, which they are still in effect until at least 1 July 2027, I can simultaneously build my wealth and save tax, right? Now, for me, Sam probably gave me the example there, but let's say I have $100,000, right? I'm not 35, but let's just say I'm a 35-year-old client, take the money, and I can go and put that into the market, right? My $100,000, and I'll get a 10% return. Give myself a pat on the back. After year one, I've got $110,000, right? Someone can take that money and go, I'll see you at the races, get the right professional team around them, go and buy something for $500,000, right? And they put up the 20% deposit. Maybe they bought something a little bit more, paid a little bit of LMI. That property, let's say it's at the start of its growth cycle, and then that's now going to compound at 7 to 12% per annum whilst it's in its growth cycle, obviously. Do 7% or even 10% to keep it like for like on a $650,000 property. I can tell you who's exponentially going to create wealth faster, right? Not only that, there's going to be someone living in that property that's going to help me pay the mortgage. Any shortfall that I have, if I'm in the 45% tax bracket, if I have a net loss of $10,000, who's going to reimburse me at the end of the year? It's the tax that I actually am going to get back. Obviously, the rules now have changed, so it suits a different demographic, of course, but those are the rules that we are still playing with for now.
Talk me through your thoughts. Is buying a family home an investment?
Can be. Absolutely, it can be. So
when isn't it?
When isn't it? Probably when you're looking at the one that's newly built with all the fancy fixtures and fittings in a really poor location.
Is that just a bad investment, but it's still an investment?
Yeah, that's right. It's still technically an investment. Yeah, but no, it absolutely can be an investment. And I think the people that do the best are the ones that actually balance lifestyle considerations with, no, this thing isn't just, I want to live here because it's the shiny object. No, this thing can actually set me up for life. If I can get somebody into a family home, particularly even more so prevalent moving forward, if I can get somebody into a family home, that is a tax-free asset. And if that can compound even at historical averages, they are going to have equity continuing to grow while they sleep, which can be used to fund deposits for future properties, business ventures, share portfolios, debt recycling, all these different sorts of projects. If you are going into the home without the balance between lifestyle and investment, let's say I'm going to go buy a new off-the-plan apartment in a non-investment grade location. If that thing doesn't grow, I'm stuck with this mortgage and interest bill, which continues to compound. And the only way for me to actually grow my wealth outside of that, if I've used all my surplus cash flow, is to pay down debt and just wait until I have usable equity. There's two ways to get usable equity. One, pay down debt. Two, just buy a good asset and watch it grow. So if you treat it right and you do treat it like an investment, in my opinion, it's the most powerful tool, right? It's going to set you up for life and leverage you into the bigger home, because what a lot of people are doing, they go and buy their first home, and then 3, 5, 10 years later, they realize that their first home is absolutely not the forever home. When they've got little kids running around, they've run out of space.
Yeah, triggered me. Tell me, sorry, I'll stick with you again, Riley. Describe the client avatar for me where you just hear their circumstances, hear their goals and objectives, and you're like, property.
Yeah. So there's not one, right? So let's actually change up the scenario. I'll go away from the family home.
No, I mean, like, whether it's family home or buy a property, where you're like, you need to buy a property.
Yeah, well, absolutely. The example I gave before, they've got more cash than what they know what to do with, right?
Yep.
We're well beyond an emergency fund now, and they're earning a healthy income, of which there is a portion of that income that is saved that they could absolutely service the loan on a property. Like, let's say they're saving $6,000 a month, just to pick a completely random number, and they have 6 figures in savings. I would absolutely not be saying to them, like, I give them the options, but in terms of priorities, I would not be saying to them, we're going into shares and there's no other option. Because with property, under the current rules, if they can afford the loan repayments, they can afford the ongoings, they can afford the land tax, they can deal with the agent's fees, they can service that. There's no other avenue, in my opinion, that's going to deal or give you that long-term benefit. Whether it be someone that is living in Bondi and renting, and they go, hey, I have all exactly what I described, but I can't afford to buy here. Yep. And this is where I need to be because this is where I work. Or alternatively, someone lives in Albury-Wodonga and they go, I absolutely can afford to be here and this is where I want to live, right? So whether it's an investment property or a family home, it's by the by, there's pros and cons of each. Family home's probably more important moving forward now. But that's the exact scenario I'll be looking at it. Do you have the security, the leveraged asset to grow your wealth? Because I think it's the first thing that people should be aiming for.
Yeah. Same to you, Sam. When you describe again your client avatar where you're just like, oh, no, not property. You need to invest in shares.
I'd probably look at it from what sort of their asset position is, what are their goals, and then look at what are they actually saving. And one thing that we probably haven't touched on is your borrowing capacities. It's not infinite. It does cap out eventually. And if you've sort of capped out and you've got, say, your family home, 3 or 4 investment properties, and you've got maybe 100, 200K borrowing power, well, then you probably can't really get into a property with that amount. So then you might look at, we'll say, let's look at debt recycling if the family home's still got some non-deductible debt, and go, let's look down the share avenue. What sort of cash flow surplus do you have straight away? Do you have an emergency buffer? Because if you've only got, say, 10, 15 grand and your living expenses are that per month, well, you probably need at least 3 to 6 at a minimum. So that's one thing I'd look at straight away. And where do you want to get to? And how long is our investment horizon? If it's only a 3-4 years and we can access super, I wouldn't be looking at an investment portfolio. I'd be looking at maxing out your super. So it really just comes case by case and what does the client want to achieve at the end of the day. But looking at the family home, I think I learned some hard lessons and some good lessons that every time looking at a family home, I want to have a look at it from an investment lens. Now look at what sort of the land value is, because that's really the driver of the property. So that's one of the main things as well. And I think we're going to see a lot more people using the family home as an investment vehicle to get to that next family home, because it's obviously CGT exempt. So I think that's going to be a rise, looking at blue chip suburbs.
Yep.
And going down that path and looking at family homes and how to get to that next one and so forth.
And so when are you talking people out of shares then?
When am I talking out of shares? Well, if their borrowing capacity is pretty good, they've got the family home, they've got a healthy buffer, they've got some equity we can use, stable jobs, they're not planning on having a child soon or maternity leave, or what's sort of the circumstances? And if it does make sense, well then model out, show them what the property could look like and sort of build it out from there. And if it does make sense, engage buyer's agent, get your mortgage broker on side and sort of get the whole team working together and sort of planning that out.
So Riley, equities, I think in the States have done maybe 11.8% the last 12 years. They're not facing the same macroeconomic headwinds than the Australian property market, who hasn't done that probably either. So you can make a fair argument that the long-term returns of property, for at least the medium term, are going to be far suppressed to what they've been. What would be your counter argument to that? As in, like, well, yeah, no, you should still invest in property for these reasons.
Well, People talk about Australian properties being overvalued and in a bubble. When you look at US equities, to look at your example, it's been driven by tech stocks. So over a decade ago, looking at the average PEs of tech stocks and just tech stocks generally, relative to what they are today, they're much more expensive for what you get, and they've driven a lot of the growth, which has pulled the S&P 500 along with it, right? So we're looking at two different things where I can subjectively look at property and go, oh, that's in an asset bubble, and it probably future performance isn't going to be as good as past performance. But then I could also make the case that the S&P 500 in the last 3 years with double-digit returns relative to the next 3 years, are they going to achieve the same returns, or are they going to revert to the mean? Okay. One thing that I think is really important that people need to look at is this asset class or investment down because it's just part of the ride? Or is it down because of structural reform? Okay. Now, structural reform doesn't always mean it's going to be forever. Like we said, we've just seen the biggest structural reform in the last, or tax reform in the last 20 plus years, 25 plus years. Is that going to be the case in 3 years with another election? So maybe somebody that was sitting on the fence, and Sam mentioned a great point here with borrowing capacity. Maybe the borrowing capacity is down because interest rates are up and negative gearing can't be counted. So maybe they can't go into property at the moment. But if you've got equity building up in the home, or you are working on some more fundamental things like building up your emergency fund and ticking off a couple of lifestyle goals, it might not be we're getting rid of property. It might just be, or we're not investing in property. It might just be we're not investing in another property right now. I think that is the important delineation, and something we'll talk about coming up soon is property and the changes of that, because there's more than one way to get a property. It's not all individual names as well, which is what it has been, because that's the main benefit, or was the main benefit through with the negative gearing.
Yep. And Sam, say similar situation, you've got someone that's coming to you and you know, diversification, it's more liquid, you've got more access to it, but I can't borrow money that easily to get into shares. So even if I'm getting an 8% return from property for the next few years, I'm still far better off borrowing. How would you counter that argument with equities? I've probably just given away some of the answers anyway, but I mean, what would you say to balance out that conversation? And I reckon a lot of the answers have already been hidden in a lot of already what's being said. So maybe it's, you know, just a summary.
If they still want to look down the property route, like I can just show them what the outcome's going to be, and looking at the shares too. But you want to look at the diversification too. You're placing a big bet. Say you've got all your wealth tied up in property. And like I said, with cash flow and just emergency buffers, like you need to consider that. Like I had a client that was looking at going into property, wanted to start investing, wanted to do all these great things. And that's great to do that. But they had no emergency buffer and they were rebuilding their home. So if this home blows out, and obviously construction costs are blowing out at the moment, and we go and invest, or we go get a property, and then you need those funds, you're going to get hit with stamp duty, you're going to have agent fees, you're going to have all these issues. And if the share portfolio drops, you're going to have issues there too, and you might not get the same money you got back out. So I think it really just comes down to the client, the situation, what they're comfortable with, what's their risk profile, and what's the end goal at the end of the day, because that's why we do everything we do, is it's goals related. So if your goals sort of align, but you still want to go down that property route, I'll just give them the warnings about what could occur. And I've seen some people be in negative equity positions, and obviously that's not an ideal situation. You end up in a mortgage prison where you can't sell the home because it's negative compared to the loan, and you're going to end up with a debt there. So you really need to weigh up that. And if you have a really bad tenant, trashes a place, can you afford 20, 30 grand in repairs? If you can't, well, that's obviously a red flag for me, and I'd raise that. So it really just comes down to their situation and what they're willing to stomach.
I think to build upon what Sam said there, and this is meant to be a debate, but it's actually been an overly friendly discussion, which I'm not a fan of. There's just, if we're looking at a checklist of have you got these boxes ticked off, the upsides of property are astronomical, right, with leverage. But there's probably just a few more boxes on your self checklist that you need to probably have in place in order to take that leap of faith, in my opinion. A few more criteria you need to meet. Yeah, 30-year-old can invest in shares. They'll do very well over a long period of time. So can a 55-year-old. But a 55-year-old with 4 birthdays left until they're age 60 and they don't have $2.1 million in super, they'd be an idiot to do it. Okay.
Yeah. So it sounds like structure is more important before the asset class anyway, even though this is really an asset class debate.
Sam touched upon it. Goals first, strategy and
Strategies.
structure sort of come hand in hand in the middle, whether it's you start with the strategy and you look at 3 or 4 different modeling scenarios rather than saying we're doing shares or property, you give them 3 or 4 different modeling scenarios. Then we look at the appropriate structure based on their preference of property or shares, right? Or super, right? And then the last one is what is the appropriate investment? And if we're talking shares, the advisor can advise on those sorts of products. If we're talking property, we delegate to the best buyers agents in the country.
Mm-hmm.
Beautiful.
Riley touched on too around the earning capacity. If you're just earning a MOTS, as like Riley likes to say, well, that can also solve a lot of issues. Touching on from your standpoint,
There's no point buying ETFs on your phone, paying your 4% dividends if you're in the 45% tax bracket, and enjoy those dividends, giving half of them to the ATO.
Yeah. So it sounds like, just to summarize, I mean, realistically, each has its list of pros and cons that, can be countered by the other side, and inherently they all have an amount of risks. It's just what's most suitable for the client given how many boxes they can tick from each side, and then what are they comfortable with.
That's exactly right. And at the end of the day, it's about allowing your client to make informed decisions themselves. We're here to advise. We're not here to control. It is not necessarily our way or the highway. It is, here are 3 or 4 options. At the end of the day, you're the CEO of your own life. Knowing these 3 or 4 options, you can now go and make a more informed decision about the path that you want to walk down. There'll be plenty of times where we advise potentially path A is better than B or C or whatever it may be, but then they go with the one that they wanted to do anyway. And there's nothing wrong with that. That's the society we live in, freedom of choice. But just to round out this conversation, like Sam said, goals need to lead the way. And we've talked a lot in this session here for July about tax reform. That's the hot topic at the moment, and what's starting to get passed through. Tax reform is all anyone wants to talk about and how that impacts their strategy. We don't implement a strategy because of a tax outcome. We implement a strategy because it is going to take us from point A to point B. Receiving or not receiving a tax benefit is a side benefit. That's the 3rd or 4th reason we may do something. We do not go out there and buy, to go back to property, a property just to save tax. No, we buy property to make money. Saving tax is the 2nd or 3rd best thing about it. Okay.
So you're not going to buy, save $1. I'll spend $1 to save 30 cents is not a strategy of Riley's.
Absolutely not.
I cringe when I hear that. Honestly, when someone says they're just going to get a tax deduction and just spend money for the sake of it, just to save 30 cents or whatever their marginal tax rate is, like, what are you doing? You got rocks in your head if you think that's a strategy going to get you anywhere in life.
Beautiful. Well, let's wrap it up.
Strategy.
That's right. Let's wrap it up for July. And yeah, you'll see us back here in August talking about some upcoming changes to self-managed super funds and limited recourse borrowing arrangements, plus plenty more.